While the U.S. economy is witnessing historic inflation and a forthcoming recession and stock market collapse, many financial experts and billionaires are worried. The federal government, on the other hand, has other opinions. Recently, the chair of the U.S. Federal Reserve, Jerome Powell, made a statement claiming the possibility of a recession, but reassured that it wasn't likely to happen. So what is Powell's take on the economy, and what did he say? Let's take a look in this video. Many experts believe that the U.S. economy is slipping into a recessionary period, and with the sanctions on Russia over the Ukraine war in the eastern Donbass region set to boomerang, bringing stocks down and the entire money market into a tailspin, reversing the bullish trend. Judging by analysis by various economic experts, billionaires, investors, players in the stock market, and even officials in the government, the economy is going into a tailspin and markets are set to plunge 40%, a cause for concern as at least 6 out of 10 Americans put their savings in the stocks, hoping to grow their earnings. But don't panic is the advice of most players in the stock market. Billionaire and big-time hedge fund investor Leon Cooperman says the U.S. economy will go into a recession and stocks will fall much further. He recently told CNBC the S&P 500 would fall 40% in total from peak to trough. He said the index might not bounce back until it hits 3,000, 20% below the recent close. Cooperman, who is a veteran hedge fund investor, believes U.S. stocks still have a long way and are set to fall further. This certainly doesn't feel good for the economy. He has predicted the economy will tumble into a recession next year, in 2023. A total drop of 40% is what he predicts, as he feels recession has battered corporate profits. He said equities were unlikely to head back into a bull market anytime soon. This is based on the trend that in recent times, investors have dumped stocks in 2022 as the Federal Reserve has embarked on what is likely to be one of the fastest interest rate hiking cycles in its history in an effort to tame rampant inflation. In fact, even the crypto exchange is down by 86%. Now, according to Bloomberg Economic News Analysis, traders whose fear of the Fed sent markets hurtling into bear territory are girding for a long dark night as stocks head for their longest slide in months. Investors are keen to see whether the central bank gives any indication as to whether it will raise rates at a faster clip. Indications are it will, as it's the only option to rein inflation, claimed to be the worst in 40 years. Stocks notwithstanding, President Joe Biden claimed that the U.S. economy was humming with its low unemployment, saying the powerful recovery from the pandemic recession will become more evident when inflation subsides. "I truly believe we made extraordinary progress by laying a new foundation for our economy," Biden said at a meeting of the AFL-CIO, the biggest U.S. labor confederation, on Tuesday. In addition to tapping the nation's strategic petroleum reserve to address high gas prices and working with European partners on plans to get Ukrainian grain to market, Biden cited proposals aimed at bringing down the cost of childcare and prescription drugs and said the wealthiest Americans must pay their fair share in taxes. "I have a plan to bring down the cost of gas and food," he said, seeking to position the Democratic Party for the coming 2022 midterm elections for all the 435 seats in the House of Representatives on November 8 this year. The U.S. imposed sanctions on Russian companies and exports, including oil, over the Ukraine invasion. Biden officials now acknowledge that the sanctions affected the U.S. economy. They're now quietly encouraging some U.S. firms to use Russian products to try to offset the damage, analysts claim. Federal Reserve Chairman Jerome Powell, meanwhile, says the central bank is committed to regaining control over inflation, even as he acknowledged the Fed has little power to address its most visible symptoms at the gas pump or the supermarket. Powell addressed the Senate Banking Committee a week after the Fed ordered the largest interest rate increase since 1994. The central bank is under growing pressure to combat inflation, which hit a 4-decade high of 8.6% in May. Powell's main concern was bringing down inflation. "We need to get inflation back down to 2%, he told lawmakers. "We're using our tools to do that, and the public should believe that we will get inflation back down to 2% over time." Senator Elizabeth Warren cautioned that an abrupt increase in borrowing costs could produce a surge in layoffs, while doing little to untangle supply shocks that have driven up the price of gasoline and groceries. "You know what's worse than high inflation and low unemployment?" Warren said. "It's high inflation and a recession with millions of people out of work. I hope you'll reconsider that before you drive this economy off a cliff." Powell stressed the economy is well positioned to withstand higher interest rates, although he acknowledged that the war in Ukraine and lingering supply chain problems increase the risk of an economic slowdown. "It's certainly a possibility," Powell said. "It's not our intended outcome at all, but it's certainly a possibility. "We're not trying to provoke, and don't think that we will need to provoke, a recession," he added. "But we do think it's absolutely essential that we restore price stability, really for the benefit of the labor market as much as anything else." A growing number of forecasters now see storm clouds on the horizon. Economists surveyed by the Wall Street Journal put the odds of a recession in the next 12 months at 44%, up from 28% in April. Powell argued that predicting recessions is notoriously difficult, but added that he doesn't see the risk as particularly high. "The U.S. economy for now is strong. Spending is strong. Consumers are in good shape. Businesses are in good shape," Powell said. "Monetary policy is famously a blunt tool, and there's risk that weaker outcomes are certainly possible, but they're not our intent." After keeping interest rates near zero for the first 2 years of the pandemic, the Fed is now moving aggressively to increase borrowing costs in a bid to tamp down demand. The Fed's benchmark rate has jumped to 1.6%, and additional rate hikes are expected in the coming months. Mortgage rates have also climbed sharply in anticipation of the Fed's moves, and that's beginning to weigh on both home sales and home construction. Some Republicans on the committee faulted the Fed for waiting too long to crack down on inflation and blamed the $1.9 trillion relief bill passed by congressional Democrats last year during the pandemic for fueling consumer demand. The Federal Reserve and this administration failed the American people by not heeding these warnings a year ago and not acting sooner to address it, said Senator Richard Shelby, Republican in Alabama. Powell and other officials have admitted that they initially misjudged both the severity and staying power of inflation, but the Fed chairman insists he's determined to bring prices under control. "We have the tools and the resolve, and hopefully the judgment to accomplish that task," Powell said. Powell also revealed that there was no guarantee the central bank can engineer a soft landing for the U.S. economy. "We think that there are pathways for us to achieve the path back to 2% inflation while still retaining a strong labor market. We believe we can do that," Powell said during a panel discussion with other top heads of central banks at a European Central Bank Policy Conference in Sintra, Portugal. Powell quickly reiterated that there's no guarantee that we can do that. "It's obviously something that is going to be quite challenging," he added, only made more difficult by the events of the last few months, such as the war in Ukraine. Despite the contraction of economic growth in the first 3 months of the year, Powell was upbeat about the current health of the economy. Households and businesses were in strong shape, and the labor market is tremendously strong, he said. In fact, the Fed is engineering slower growth moderate, as he said, a necessary adjustment to let supply catch up with the strong demand. "Is there a risk we can go too far? Certainly there is a risk," he said, "but I wouldn't agree that it's the biggest risk to the economy. The biggest mistake would be to fail to restore price stability," he said. "The Fed will not allow a transition from a low inflation environment into a high inflation environment," Powell said. "The Fed needs to get its benchmark policy rate into restrictive territory fairly quickly," he said. Well, that's all for this video. Thanks for watching.